Great. So our next session is an update from CBDC. Paul is here. I see Michael as well. Oh, Michael will lead the session. Michael, you look like an angel. There we go. That's much better. Would you want to go ahead?
No. Keep talking, Simeon. You're saying lovely thing. Right. Let me share my screen. And I will brace myself for the tsunami of disappointment that I know is going to break over my head when I say that actually this presentation was supposed to be done by Julie Guetta from Platio. But unfortunately, she's not able to attend today. So I am going to substitute, albeit not very well, for Julie. So I will ask for your indulgence and take this presentation away. I can find the right buttons. Okay, so as you know, or you may not know, the Mojaloop Foundation set up a Centre of Excellence jointly with the Monetary Authority of Singapore to look at potential use cases for CBDCs, central bank digital currencies. What's happened in the meantime is that a small group has been looking at potential use cases before we take that to a larger group for actual implementation. And what I have to talk to you about today is the fruits of our labours in that area. So we identified 3 potential use cases.
Michael, perhaps you should clarify that this is for wholesale CBDCs, not retail.
Absolutely. I'm very happy to make that qualification. For those who need the distinction explaining, wholesale CBDC is CBDC which is only issued to institutions which already have accounts at the central bank in the jurisdiction. Retail CBDC can be issued to anybody, either to smaller financial institutions or indeed to individual customers. As Paul rightly points out, our remit was to talk about and investigate wholesale CBDC. Okay, so the objective was to see how CBDC could be used for the settlement of payments, and we identified 3 potential use cases. First of all, settlement of payments which were cleared through a single domestic instant payment system, settlement using CBDC. Second, settlement of payments which were cleared through 2 linked domestic instant payment systems using CBDC. And finally, settlement of cross-border payments cleared through 2 linked instant payment systems using CBDC. So I'm just going to spend most of the presentation time talking about the content of those 3 potential use cases. So first of all, settling payments with CBDC for a domestic inclusive instant payment system. So typically, the RTGS systems, which are generally used for settling payment systems, they have some limitations. They often, or mostly I would say, don't operate 24/7, and sometimes they operate quite restrictive hours. They're based in a technology that doesn't offer programmability of money, that is CBDC. Access to participants is regulated, effectively limited to participants who can hold accounts at the central bank, and is therefore limited. Not only that, not all jurisdictions, especially in the emerging economies world, have implemented an RTGS system. However, generally and speaking, it's safer, both safer and cheaper for participants in an IPS to settle in central bank money rather than using commercial bank funds, which take with them an element of risk. So our objectives really were to assess the efficiency gains that CBDCs might offer, such as moving to atomic settlement and being available 24/7 for liquidity cover changes. And second, to understand whether the use of CBDCs could enhance access for smaller and less formal institutions, account holding institutions, that is. So how does this work? The idea is that the clearing of a payment will be performed by the IIPS, by Mojaloop, for instance. We assume that this applies to an IIPS in which some participants already have access to CBDC accounts at a central bank. The central bank then offers wholesale CBDC for purchase by large commercial banks at a fixed rate against the fiat currency, the actual currency of the country. We assume a conversion rate of 1-to-1 for simplicity, but it wouldn't have to be like that. The large banks then purchase CBDC from the central bank. And the IPS declares that its central currency will be CBDC, settlement currency will be CBDC. The large banks provide liquidity cover by forwarding CBDC to the IPS. The CBDC, in that case, I think there's a typo there, the CBDC is controlled by the IPS. The IPS. So participants can't withdraw liquidity from the scheme without the IPS's consent. Small IFIs who don't have direct access to CBDC provide liquidity cover by advancing fiat currency to the IPS. IPS uses this to purchase CBDC from a large bank at a fixed rate and credits that CBDC to the small participants' liquidity cover. Now, all the participants in the scheme can settle among each other using CBDC. When a participant wants to withdraw liquidity cover from the system, then they can do that. If they're a large bank, the IPS simply returns the CBDC to the participant. If they're a small bank, the IPS sells the CBDC to a large bank at the fixed rate and returns fiat to the participant. So that's use case one. There are some issues with that we would need to look at. First of all, what are the regulatory consequences of this proposal, and in particular of a scheme's ability to hold CBDC and for a scheme's ability to purchase CBDC on behalf of smaller institutions. And we've certainly had people in the working group say that means it's not wholesale CBDC. Does this require the IIPS scheme to be allowed to hold CBDC? We think it probably does, but it might not. And as I've just said, in what sense is this a wholesale or a retail CBDC? Final question, why don't all types of financial institutions have access to central bank funds? And there is also a question about relations between the possession of the CBDC and access to the RTGS. In this case, I think we would expect to see that the IIPS itself would be able to operate an account or one or more accounts at the RTGS for the transfer of CBDC funds. And we would also want to look at ways of implementing a CBDC which partly or wholly replace RTGS. So that's use case one. Use case two builds on use case one. And the scenario is that some jurisdictions support more than one IPS. The Philippines, Kenya, Europe, perhaps India in the future. All have, when I say Europe, I mean the Eurozone, all have more than one IPS operational at the moment. Typically, this is either solved by introducing an overarching scheme in which both schemes settle. For example, TCIB in SADC, which is an organizationally expensive form of solution because you have to implement a whole new scheme in order to, which everybody has to join in order to settle, or by using a correspondent relationship where a single FI is a member of both schemes and effectively mediates between the two schemes for settlement purposes. This is the Mojaloop approach, at least as we looked at it up to now. It's not clear that it would be easy to support this arrangement in all schemes, particularly where schemes are restricted to a particular type of institution, and therefore it might be difficult to identify a single financial institution which would be allowed to join both schemes. And this is a costly form of solution. So the objectives here are to allow multiple IIPS schemes to settle with each other without requiring correspondent bank relationships to manage the settlements and without requiring FIs to manage the credit risks associated with settling and using, of course, CBDCs. So how does this work? Well, we imagine two IIPSs, Scheme A and Scheme B. The IIPSs exchange messages about inter-scheme transfers using an adapter, a cross-network provider in our world. Each scheme records its own obligations. So CBDC systems act as a bridge for the PSP customers to transfer funds among themselves. Although customers won't hold CBDCs, the WCBDC could be used to switch, clear and settle customer transfers initiated from non-CBDC systems. And since both schemes are in the same jurisdiction, we don't have to worry about currency conversion. We assume for the moment that both schemes have the same settlement structure, and for simplicity, that this is multilateral net settlement. It was not necessary, it just makes things simpler. Obligations between Scheme A and Scheme B are recorded in a correspondent account in each scheme. And there's a quick description. The balances in these accounts we expect will be mirror images of each other and will represent the net obligations of one scheme to another scheme. Settlement within each scheme will include the correspondent accounts. So if a customer in Scheme A has transferred to 10 $10 to a customer in Scheme B, then F1 owes 10 $10 to the due to or from Scheme B account in Scheme A, and the due to or from Scheme A account in Scheme B owes $10 to FI2, the second, the receiving financial institution. This is standard correspondent banking arrangement. And Scheme A, that means, owes $10 to Scheme B. Settlement between the schemes will be done via a transfer of CBDC from the debtor scheme to the creditor scheme. We may have settlements synchronized between the two schemes, in which case CBDC is transferred as part of the settlement process, or they could happen on different schedules in which schemes may need to provide liquidity cover to their counter schemes or the funds that they owe to the counter schemes. So that's use case 2. Use case 3 is cross-border CBDC. Now, the current state is that instant payments adoption is reasonably high, and the focus is starting to switch to interoperability. The question is how that interoperability is to be done. The diagram you see there is a diagram produced by the Bank of International Settlements Nexus project. The interesting point about that project is that settlement, as you see down here, is provided by the liquidity providers and the foreign exchange provider. And that still relies on a standard nostro-vostro correspondent relationship, which, as we know, is currently a significant cost addition to interaction between schemes. I suspect, this is just my personal opinion, you understand, that the Nexus people got rather ambushed by large banks. But anyway, so there are a lot of challenges with the settlements of cross-border payments. So our target is, you saw this slide yesterday, so I won't reiterate the target. These are the overall world targets for the reduction of costs for cross-border channels. The challenges are the settlement risk first. First of all, the risk that liquidity isn't available. And particularly, that's a worry for EMDE, emerging markets and developing economy currencies, as they may involve multiple transaction legs. Second, settlement duration. Where there are multiple transaction legs, settlement may need to go through several legs running on different cycles, so it may take a fair amount of time for the funds actually to arrive at the target institution. Then there are liquidity constraints. It's often not easy to access liquidity in some EMDE currencies, particularly if those are run across the world. And finally, there are regulatory challenges. EMDE currencies are sometimes subject to more stringent regulatory requirements than currencies for larger economies, including restrictions on capital flows, documentary checks, and so on. So the idea for the use case would be to look at different models for settlement using CBDC. Since we think the traditional model will make it very difficult to reach the KPI on the left-hand side there. So what assumptions and potential use cases are we looking at? First of all, our assumptions are that the payments will be cleared through interconnected IPS systems, and therefore we don't need to worry about that, clearing the payments. It's only settling the payments that we need to worry about. By settlement, we need access to required liquidity in the right currency and the record of the position of cleared funds in the various ledgers. Potential use cases then could include settlement of payments cleared through Nexus. You'll recall from the Nexus diagram that there is an FXP providing the currency conversion and settlement services between the various schemes. And it's possible that we might think about a CBDC-based scheme, which would provide a settlement service that could be used, for instance, by participants in a Nexus scheme. Second, we could look at settlement of payments cleared through two instances of Mojaloop systems and replacing the cross-network provider. Today, the cross-network provider is a technical component that creates the messaging interoperability, and it's an entity that operates as a liquidity provider, but we might be able to remove the second of those and locate it somewhere else. So the objective is to suggest a different model to settle cross-border payments cleared through two linked IPSs. So there's no correspondent relationship. It doesn't rely on the traditional correspondent banking relationship. Second, that there's no alternate network, i.e. doesn't use a costly existing network such as Visa or MasterCard, which make this an expensive option. And finally, one that leverages CBDC. And we've got here different models for how CBDC might be used to settle. On the left-hand side, a single platform with a single technical currency infrastructure and a common rule book. mBridge is an example of that. Foreign exchange happens on the platform. Second, bilateral links, where CBDC systems are directly linked to each other through technical and contractual agreements, i.e. a point-to-point relationship. And CEDA-UBIN, which is the US experimental CBDC scheme, uses this. So foreign exchange can happen through a liquidity bridge. And finally, there is the hub and spoke model, where there's a common hub which connects to separate CBDC systems of the participating jurisdictions. And foreign exchange can take place either through an automated money market, like Mariana, or through a vehicle, i.e. reference CBDC currency, which we might call UN CBDC or something like that, i.e. a non-national CBDC, which all parties could make use of. So there are pros and cons to each model. I notice that my time is almost at an end, so I don't want to go through those in detail because I can see at least Aaron J has his hand up. Our intention then is to explore Model 3 and to look focusing on a single corridor where there are two instant payments already linked or about to be linked. We will develop an assessment matrix, explore and assess the various models for a selected corridor, publish the matrix used to assess the models, and finally develop the model selected and commit the code against the Mojaloop repository. The suggestion is to focus on use case 3 because we think use case 1 is probably already delivered. The World Bank has done some work on this, and we think that they've probably at least demonstrated the potentiality of this. Use case 2 is basically a hybrid between use case 1 and use case 3. And there are limited jurisdictions with several domestic instant payment systems, though, as we've said, they do exist. So the next step is to decide the corridor, assign resources to look at this corridor and the various models. Arun J.
Hi, Michael. I was just asked to type it in, but I'll just quickly ask this question, and you may have a sense that it was coming. So the question is really why CBDC, especially as they don't exist, versus tokenized deposits, which can pretty much do everything the CBDC can do and achieve all of the stated objectives. And, we can also be in M0 effectively as well. So, yeah, that was my question.
Okay, so my answer to your question is I want to take you back to the conversation that Steve just had with us and say the CB part of a CBDC and the national part of our focus are, we think, quite closely aligned with each other. And that therefore we are expecting that where jurisdictions are planning to implement a national CBDC, a national instant payment system, they will be more likely to view with favour a central bank digital currency than they would the various tokenized currencies, which I admit already exist. I have to say that also my experiences, I don't know what yours is, that those existing tokenized currencies are pretty good if you want to move funds between dollars and euros and renminbi and those sorts of things. Not quite so good if you want to move them between those funds and Mawalian kwachas, for instance. So that's my answer.
Okay, well, we can continue this discussion further as we're out of time. But I think there's some really interesting things we can do with tokenized deposits, which are different from stable coins and those sort of this is as tokenized deposits as in fiat money. And I'll reply to Miller's question as well. Okay,
so as usual, Arun J. I will look forward with anticipation and desire to hearing your thoughts on this matter further. And now Simeon recalls me to my duty, says that we're over by 13 minutes, and asks if we can wrap up, to which my answer is absolutely, definitely.
Thank you, Michael. I appreciate that. We've